The unique L20 trading framework. The purpose for this presentation today is to give you guys a very good understanding of the foundational concepts that make up the L20 trading framework, and help you understand a little bit about auction market theory, market profile, volume profile. For those of you that are completely new to L2ST and the trading framework, all I suggest is just have an open mind. I'm assuming most people have some kind of intro to market profile, auction market theory, being here in the first place, because that tends to be the client base that I typically work with. I typically work with people that actually do understand auction market theory, market profile, volume profile. So it's not specifically for complete beginners and newbies, although it's going to be quite basic stuff that I do cover today. So although it's basic, the most basic stuff and the most foundational stuff is probably the most important, because without that, you don't really have anything to build upon. So you always need a very good foundation to build upon. And with the L20 trading framework and trading with any style, really, if you've got a good understanding of the basics and what actually creates that way of trading, what makes sense, what's at the heart of that trading style, if you understand that really, really well, you have a much better chance of being able to apply things more effectively, and also not only effectively, but also become your own boss in a way, in the way that you actually trade. Rather than being a follower, you actually become more of a trader, and you can practice trading as an art form because you understand the foundational concepts. And if you keep applying them on a consistent basis in a structured way, you become a master of those concepts, and you also begin to develop the ability to run through the whole trading process in a way that actually is very structured, which allows for discipline. So the whole point of the L20 trading framework is, I'm still getting some comments, people saying, are you there? So I'll just do one more quick sound check and make sure you guys can see the screen. Okay, so basically, you might see some comments coming in from admin, and just letting others know if they can't hear anything, see anything, because there's always going to be someone that don't have the visuals, don't have the audio. So I can't let that hold us back. It's going to be recorded anyway, guys, so you guys are going to be able to catch this in a recording. Let's get straight into this. I'm going to quickly go through the disclaimer that I normally bring up. L2ST does not have any knowledge of the trading needs, objectives of individual viewers of this presentation. This presentation represents suggestions, training, and information for viewers to use when evaluating and making trading decisions in light of their own individual trading goals, and does not constitute specific advice. L2ST does not take into account the trading objectives, financial situation, needs of any particular person. And before making a trading decision on the basis of an L2ST method of trading, prospective traders consider with or without the assistance of an advisor, whether the advice is appropriate in light of their particular trading needs, objectives, and financial circumstances. Trading the futures markets involves risk, revenue can be gained, and expenses may be accumulated. Now, you guys probably noticed that I don't use the word you can make money and lose money like I used to, because I don't use that language in my trading, and there's specific reasons why, because trading is a business and it's not about winning and losing. So I don't use that language. If any of you guys know what I do and what I teach and how I run my business, you guys will know the importance of that. If you don't, I'm sure you will learn. So let's talk about some of the issues that most profile traders face. Like I said, this is not really for those that are completely new to profiling, because the kind of client base that I work with and my niche really when it comes to training and coaching traders, I try to work with those that are struggling with the use of the profile because of their inability to be able to apply it effectively or get consistent profits and results from the application of it. So let's have a look into some of the issues that I consistently come across when working with traders and helping them through those obstacles and overcoming them. So some of the things that I often hear come down to these facts, and sometimes it's just quite simply not enough understanding. And of course, not enough understanding has a knock-on effect on your belief and confidence. Now, you have to be truly honest whether you understand something really well or not. Sometimes, you know, one of the things in trading is that your understanding, your knowledge, and your experience is always going to grow. It's always evolving. It's always growing over time. But the thing is, you have to be very open and admit if you don't understand something well, so you can be putting yourself in a position where you actually take the time out to actually learn it and understand it well. Because if you try to understand market profile and auction market theory and the basics and start applying that, it really, in a way that you really understand, like you can know everything about market profile, you can read many books, attend lots of seminars, but if you don't truly understand it from the foundation up, it's not going to be really useful. And you can't really move on from that. So just explaining some of the concepts in a very simple way that you can understand and making it easy to apply. That's really my objectives, make auction market theory easy to understand and easy to apply in a very structured way. The thing is, without this understanding, you will have doubt, fear, and anxiety, because you of course are going to have doubt, fear, and anxiety. It's very obvious that should be there if you truly don't understand what you are looking at and why you are making the choices and the decisions that you are making in your trading. So you have to firstly be able to admit that. And what I want to share with you is that there are ways to look at auction market theory, market profiling, and you can apply it in many different ways. And there happens to be this influx of people getting into market profile, auction market theory, because they're trying to move away from systematic mechanical trading, trying to get into more of the mindset of the marketplace. And typically people go down this journey where they start looking at mind over markets and the work of James Dalton, Stoudemire, which is the pioneer of market profile, auction market theory, and, well, not auction market theory, but market profile and the development of the tool itself. Now, these guys are the pioneers. They, massive respect to them. They helped me understand the basic concepts. But I also didn't get a few things, which was a very structured approach and also a practical approach to actually applying those concepts. So that's something that I had to create myself. So I want to give you an insight of how I started trading, what I understood before auction market theory and market profiling, and which I still use right now, because that actually makes up the altruistic trading framework. It's not actually just the stuff that I've learned when it comes to auction market theory and market profiling. And that's where the altruistic trading framework does differ to many other market profile, auction market theory educators out there, because there's been an influx of these educators in market profile, auction market theory, because many people have moved in that direction. When I first started teaching auction market theory, market profile, there wasn't many educators around. There's a couple, okay? A couple of names come to mind. Now there's quite a few. And what you have to be very careful with is that you are actually learning from someone that has used it for a while and actually understands the concepts really well. And it's not difficult to figure out, because you can tell when somebody is just sharing the information that's being read and just regurgitated in a way, because they're just saying the same old stuff again and again and again. So you guys will probably hear things like, you know, the TPO analysis using the daily profiles, initial balance, extensions, etc. A lot of these things are the traditional market profile concepts, and a lot of them are useful, but in my opinion, a lot of these concepts are quite outdated with what the software can do these days and what you can do. And also, I do find many of these concepts, they don't fit into my style anyway. So I know they work for some, but basically just understand that not every auction market theory, market profile trading methodology is the same. So, you know, try to look for something that makes sense and resonates with you, and make sure it's practical. Make sure you can actually look at it and say, wait a minute, that definitely is applicable, and I definitely can use that because it makes sense. So always look for that. So I'm going to try to show you some foundational concepts today and give you an insight into how I apply auction market theory. And actually, with what you'll get in the next 45 minutes or so, is actually going to give you a very good foundation. If you can really understand this, you can really grow from that. Even though it's a very short presentation, it is the foundation of everything that I do. Okay, but it's also been a journey. It's evolved over time and it's got better over time. And this is the result of that. So I want to show you some of the concepts, and it really is simple. And I, even myself, I admit, I put my hands up. I have even tried to overcomplicate some of these concepts myself. Okay, so what you will realize is that you can make it really simple. And the simpler you make it, the easier it is to follow. And therefore, discipline is more likely. And we all know discipline is necessary. And we all know we have to follow our plan. But if the plan is really complicated and there's too many choices and decisions, so, you know, this is one of the issues. The approach is not structured enough, too much choice, opportunity. If you have too much choice, too many ways to trade with those tools, just like with candlesticks, bar charts, there's lots of ways to look at a chart and make sense of it and make decisions and choices and trade. Sometimes too many. There's too many opportunities. Right? If you really look from, there's too much opportunity in the marketplace. And that's why people overtrade. You know, the biggest issue that I come across is overtrading. People taking 10, 20, 30 trades just within the first hour. You know, that kind of stuff it's more like you're gambling, because if you really have a good understanding of what you're looking for. Now, I'm not talking about scalping. Scalping is a different business and different game altogether. You are basically trading very short term, in and out very quickly. Now, some of the stuff I teach, it does apply to scalping, and I think it's still possible to do business as a scalper, but it's not what I specialize in. And so next point here, specializing in certain styles of trading and certain markets is very, very important, because if you try to do everything and anything, of course, that's going to lead to overtrading, and you're going to try to find opportunities, and you will find them. Sometimes opportunities that really you shouldn't be interested in. For example, like opportunities where the market's moving very quickly. We've seen that recently with the US indexes. You know, you chase the market because you see opportunity everywhere. The biggest issue for traders is not necessarily finding opportunity, but actually defining what's a good opportunity and what's not, right? I'm sure you guys will agree. If you do, please let me know in the chat box, okay? You guys have to understand that finding opportunities is not difficult. Finding better opportunities is a lot more difficult, and it takes a lot more skill. I mean, anybody can sit there, open up a trading platform and take trades, right? So just sitting there taking trades is not the objective. You have to take better trades, and you have to be able to find them, and you have to be patient enough to wait for them. That's where the discipline comes. But you need something that helps you do that. You need a structured approach. So not knowing when to trade towards value or away is one of the issues a lot of auction market theory profile traders face, because we have this idea of trading back to value, this reversion back to the mean, reversion back to the VPOC, the volume point of control, or the POC point of control. That all makes sense. We all know if something's overpriced, look, it's better to sell it. If something's underpriced, it's better to buy it. You know, this is nothing new. You know, this is common sense stuff. So people go to auction market theory, market profile, and think, oh, well, this makes a lot of sense. I now know when it's overbought, oversold, not because the indicator says, but I can see where value is. But the issue is, if you sit there and try to buy above value and sell above value and sell below value and buy below value, and you try to make those choices and decisions in real time, you're likely to fail, because you are going to be skewed towards making decisions and choices in reference to what's happening very, very short term. You're going to sit there and say, look, I think I should fade it. Wait a minute, that's not working. Let's get long instead. So this idea of reversing ideas and opinions and beliefs about the market starts to happen. So if you've ever sat there, shorted the market and thought, wait a minute, no, I should be long instead, got long instead, should never be a situation. If you really, really have belief and confidence in being short, that should be your focus. If your belief and confidence is in being long, that should be your focus. Should not be a situation where you're buying and selling at the same price. It just shouldn't happen. So how do you get rid of this? Well, you have to have a very specific process where it says, look, this is where it's okay to buy, this is where it's okay to sell. You have to make it really clear. That's what the Ultimately Trading Framework is. It basically allows for you to look at value. It deals with all of this above. And then it helps you understand when you can trade back to value, but when you should give up on that and when you should trade away. Because at times, that's what you got to do. Less frequently, but as we've seen recently this month, And funnily enough, I said last week when we started trading again for the year, I said, this doesn't happen that often, but maybe once every 2 months or once a month, you know, that's it. But these moves that I want to share with you today are actually happening almost every day recently. And some people just don't know what to do with it. But the auction market theory concepts and the L2ST trading framework actually has been able to see these moves for a long, long time. I just don't see them that often. I've just had to apply it a lot more often recently on the US indexes specifically, and I'll show you. So many of you guys have probably been there. If you've been trading value, auction market theory, you've sat there and said, look, should I be short? Should I be trading back to value? Or is this an imbalance that's going? Should I trade away from value? Of course, balance and imbalance makes sense. Sideways phases and trends are always in the market. But establishing whether you should be trading back into value or away from value, so going with the trend and the breakout or going back into the range where we just come from, that's the most difficult part to distinguish. Which one do you focus on? So that's what the framework has been designed to do for myself, but also to share with others. It makes it a lot easier to do. So the next step, once you plan and prepare, I mean, you can have the ideas for trading below value and above value, make it really clear, but then you do have to move towards timing and execution in a very specific way. And I have a specific process for that as well. It's very, very clear, very well defined. And I can send you guys a link to a webinar that I did with Trader Kingdom, which covers that. There's also a webinar which actually all room members get, which is called a timing and execution webinar, which I actually presented on the 2nd of January this year. So it's very, very recent, but it covers everything that I look at, the whole process when it comes to moving from planning preparation through to getting ready to actually take the trade, what you need to see, defining the prices to actually execute that, and then trade management. Because without that process and understanding of it, it's very difficult to do business with discipline. So what you've got to understand is trading is a process. It's not necessarily following rules. It's a process. And if you understand the process, moving from one step to another, to another, to another, and you understand the exact process, like I talk about planning preparation and then a pre-engagement phase, then that's basically defining what you need to see in order just to engage in potential execution. Then when you engage, that's when you can move to your trading platform. That's when you can look at specific prices. I use order flow as well. Look at specific order flow and look for a specific entry. But you never get to that point until you've actually gone through the process. But most traders don't have a process like that. They sit there, they have a support line, resistance line, and they just trade it because there's a line on the charts. There is support and resistance. So auction market theory can be an issue for many traders when they don't have a well-defined timing and execution plan. So it makes a lot of sense. I mean, even what I'm going to share with you today is the foundational concept. But what I will say is that you do need to know how to time and execute those trades effectively to actually make it profitable. So I will send you the timing link to the one that I did with Trader Kingdom. I can find that for you and I'll post that up. And that covers the process in quite some detail. Just remind me towards the end of the presentation and I'll do that. Now, the foundations of the L2ST trading framework. I use stage analysis and market cycles. This is not something that you hear discussed and taught in auction market theory and market profile or alongside it because, well, I've never seen it anyway. But the reason I talk about it and use it is because it's actually, because I didn't start trading with auction market theory and market profile. I actually became profitable without it. Okay, so it's not absolutely necessary, but what I understood is that I had context. I had an understanding of the psychology of the market, which actually auction market theory and market profile helped me actually build upon, but it only made sense when I figured out how to put it into what I was already doing. So stage analysis and market cycles is one of the simplest concepts, and many people have probably come across it, but didn't pay much attention to it, but it still applies and it stood the test of time because I've been trading since 2001. And I wasn't profitable until I was a little bit up and down. I had profitable phases, but up and down like most people do. But I didn't actually find consistency until around 2003 when I started trading the YM, kept my size small, and I basically just applied stage analysis, market cycles, and I traded the range when there was range bound. I traded basically trends when it was trending. I always used the top-down approach. So the things that I use now are the things that actually help build the foundation of my whole career. What auction market theory and profiling allowed for me to do was understand it better and get better as a trader and actually get more confidence. So if it was around when I first started, of course, you know, it would have been useful, but I didn't start trading and become profitable using auction market theory and market profile. But I believe for you guys that are new to it, you have that ability. One of the things that I always promised myself when I got into trading, because there was so much crap out there, was that if I figure this out and I get good at this, I'm going to make sure that I start teaching others, because there's so much crap out there. And I mean, since then, a lot of good stuff has come out, but there was a lot of crap back then. And, you know, we had to filter through that, and I had to figure out my own ways of trading. So I got into prop trading in 2005. That helped. But, you know, I also have my little ups and downs then because I got a little bit too big too soon. You know, that's a long story, so I'm not going to go into that now. And I often talk about it in my training room. So basically, I got into prop trading in 2005. I'm still a prop trader, but I don't trade the firm's capital now. I actually basically use them as my broker. So I just clear through them. So, which is a good setup for me because I get the benefits of both, having a retail account, working my own capital, no profit split, but also at the same time, you know, I get lower rates, and I also get the ability to get an IT department behind me. So it works well. So anyway, getting into the framework itself, one of the next steps that you have to be able to do is define custom and personal value. Because auction market theory profiling typically looks at daily profiles, whilst traditionally you would have to split them, merge them, etc. I typically use a volume profile and a profile indicator, which I'll show you in a minute. And it makes it a lot easier, I think, because you can look at price, you can draw your value around it, but you have to choose where you perceive value. You have to choose what do you personally see as value for your time frame, for in reference to your objectives. Okay. So if anybody doesn't know, typically my time frame is like 30, 60-minute charts plus. And I usually look to get into trades. I might take one, maybe two trades a day because I'm looking for that main trade. Sometimes I sit out. Like last week, I only traded twice. This week, I've traded 3 times, but I've been up on one day, pretty small on Monday. And then I was down actually yesterday. Then I'm up again today, which I actually just made back what I was down yesterday. But I trade a lot on the Bund, the Euro Bund, and the Euro stocks is my backup market. And the Bund recently just hasn't had a lot of opportunity. And I do cover my analysis and run the trading room during the US session, which I actually used to trade myself as well. But I try to separate the two basically right now. But actually, the US session has been better to trade right now. I mean, it doesn't mean I have to start changing my plan, but I share my plans and I share my thoughts, my opinions and everything. So others can learn from that. The reason I do that, and a lot of people don't get this, is because I basically have a vision and a mission as part of my business plan to also leave a legacy. And that comes from the fact that I learned that leaving a legacy is important, because one of the things I had to ask myself, because my father passed away at a very young age when I was 7 years old. He was only 33. I'm 36 years old, soon to be 37 in March. And one of the things that I learned is that, you know, even though he passed at a young age, he left what I would call a legacy, because his friends and my family, everyone talks about how much of a good man he was and what he did for others. So that's the reason that I sort of share and coach and train others, because I don't have to. I'm a trader, but I do it because I like to share. I like to leave a legacy, because if I just trade away, I make money trading, no one's going to know about that. It's not going to leave anything. My family will know, my kids will know, yeah. But, you know, have I left anything behind? You know, have I left a real legacy? But if I coach and train others, you know, it's going to leave something behind. You know, people way after I'm gone can say, look, you know, this guy, this is his teachings, you know, just like others, you know, they've got their methods. People talk about that stuff. I like that. That's one of my visions, one of my missions. I've got a question from someone here, so I'm just going to quickly send a reply because someone's asking, has it started? So basically, that's why I do what I do. Okay. Now, without further ado, let's get into this. Let's get into the nitty gritty. Long-term composite profiles is something that I use. Custom personal value perception is something that I use. I draw my own profiles. I choose where I'm going to take them. All right. Fibonacci retracement extensions is something that I draw. Now, a lot of people say, what has Fibonacci got to do with auction market theory and market profile? Right. Now, I want to show you what it's got to do with it. It's got to do, firstly, with the fact that they've stood the test of time, because it's actually something that I started to use a long, long time ago, and it stood the test of time, and it still works to this day. It's fantastic. So I can't deny that fact, and I'll show you. I'll prove it to you time and time again, right? Now, you're not going to hear many people that are going to teach you auction market theory and market profile discuss Fibonacci retracement extensions, right? And you probably, if you tell them, like, this guy talks about retracement extensions with Fibonacci and auction market theory, they probably say, well, that's nothing to do with auction market theory. That's an auction market theory. Look, I'll tell you why it's everything to do with auction market theory and why it works. And I'll show you how it works, because you can't argue with the truth. Once you keep seeing this, you can't argue with it. It doesn't matter what anybody else says. The people that will say, look, that's useless, it's not going to work, is people that don't know how to use it, don't understand it, or they're just regurgitating the stuff that they learn and they've not learned how to apply it, because this is stuff that I know from my own experience. So confluence and market time frame relationships is something that's really important when it comes to timing, and I'll talk about that. Basically, that's about bringing different time frames, like the long term and the short term together, but also bringing different markets, like relationships. Like when I trade the Euro Bund, I always trade the bubble with it. I observe the bubble with it. When I trade the Euro stocks, I actually always observe the DAX. Sometimes I end up trading the DAX. When I observe the ES and trading opportunities on the ES, and when I cover that in the training room, I always observe the YM and the NASDAQ alongside it. And it's only when those opportunities come together that the trades are high probability. Like without confluence, doesn't matter. You can apply the framework, but without the confluence, it loses its profitability. It loses the probability of the trade playing out. It makes such a big difference. Now, there are some markets, admittingly, that I've applied this framework to that it works out on without confluence, like crude oil. But that's purely because of the fact that it has a very good risk to reward ratio on a typical basis. Now, there are some markets you can look at alongside that, like some energy markets, but I've never had to. And I don't trade crude oil anymore, but I have, and I know and I do cover it every now and again in the room, and we see some great opportunities around it, So what I'm going to talk about now, these are structures, things that a lot of people understand and know. This, I don't really need to go in this, but a lot of people understand price action, right? I mean, as a minimum, I would expect you need to know price action. Like, firstly, on the left, we got like a channeling market, right? We've seen that recently in the ES, then broke down. Channeling markets typically do stay in the channel for quite a decent amount of time, so you do get opportunity there. But most people will sit there, do I fade the top of the channel or do I buy the breakout? You can't really distinguish which one to do unless you have something else behind it. Both actually do work out, and I do consider both. It depends on market structure. It depends on the framework. So that itself wouldn't define whether you should be short at the unfair, the top of the range, or buy the bottom of the range, or whether you should go with the breakout. That can't define it, because it's just price action. That's the advert. That's the advertising mechanism. It just tells you where price is. Now, the uptrend, very easy to see. Short downtrend, easy to see. Higher lows, higher highs in an uptrend, lower lows, lower highs in a downtrend. Most people try to go with those short-term trends, and I do too, but at the right place at the right time. Sideways range, easy to define. Sideways market doesn't really break the high, doesn't really break the low, stays consolidated. And actually, that's my best phase, because it's the most effective and the most efficient. Now, let me move on to something else. This is something that some of you guys have probably seen before. Some of you guys may not have. Okay. Now, the market stages and cycles is the foundation of my whole trading career. It's the first thing that I found that actually made sense. I could look at the charts and say, look, I'm in this stage. This is where we are right now. This is the context. This is what I'm looking for next. Okay. So you have to bear with me with this, because a lot of people don't understand how stages and stage analysis and these cycles fit into auction market theory. Now, auction market theory, you see that I've put on to the right-hand side, which is basically the most basic concept of auction market theory and market profiling. Well, auction market theory is very, very simple. The market moves too high, the buyers stop buying and the sellers come in. The market moves too low, the sellers stop selling and the buyers come in. Now, there's no such thing as too many buyers or too many sellers, or more buyers or more sellers, because we all know it's zero sum. For every seller that hits a bid, there's a buyer on the bid. For every buyer that lifts an offer, there's a seller on the offer. So what makes the market move? Well, it's the aggressive trade, the people that are more aggressive, and they're willing to keep taking out the buyers' bids at lower prices. They're willing to keep taking the sellers' offers at higher prices. The people that keep lifting sellers' offers, they keep saying, wait a minute, no, you guys are wrong. I'm going to keep buying because I think it should be higher. It's all a matter of perception. The markets move people. And when we look at the markets, it's people we are looking at. When you look at a chart, how many of you sit there and think, okay, this is not patterns that I'm looking at. These are not chart patterns. These are not candlesticks. These are not bar charts. How many of you actually sit there and see it as the mindset of the marketplace? This is the thoughts and the opinions of this market. That's what I do. That's what I've trained myself to do over many, many years. And that's exactly the approach that you have to have. You've got to be able to look at the market and say, this is what it's thinking. This is what it's trying to achieve. This is what it's trying to do. Sometimes you're going to be wrong, but you're more of a psychologist rather than a mathematician, right? Some traders, systematic mechanical traders, they do quantitative analysis, do back tests on systems with indicators, etc. But with auction market theory, it's not a system. It's not mechanical. Market profile, it's not mechanical. You can make it mechanical, but you shouldn't, to make it more effective. What you've got to do is understand that it's giving you more of a deeper insight into what the market is thinking, what it's trying to achieve. Now, it's not one person, it's not two people, it's thousands and thousands of people making choices and decisions, but they're all human, or it's computers that have been programmed by humans. So at the end of the day, there's some logic, there's some thinking behind it. And at the end of the day, what you see as a result of that, you see thoughts, opinions, and beliefs. That's what you see. The question is, can you understand what the market is thinking? Can you understand what it's trying to achieve without getting sucked into being deluded and actually fooled? That's the question. Are you going to get sucked into being fooled? Are you going to have your strings pulled? Or are you going to watch that happening and understand it's happening and look at it and say, look, I'm looking at things from a different perspective. I can see what's going on here. That's what I do. That's a perspective you've got to have. You've got to be able to have a bird's eye view perspective. You've got to be able to look at the auction and the market and your charts from that perspective. These are people, and that's all it is. They're making choices, making decisions. And there's a lot of people getting sucked in at bad prices on the buy side and bad prices on the sell side. But where is that? Auction market theory helps you, but stage analysis is the first thing you've got to look at. So I'll have a look at that first. Let's look at stage one. That's basically a sideways phase. Now, first thing I would point out is that the markets don't have perfect cycles like this. This is an underlying concept. But as I will show you in the charts, you'll see the stages. You'll see when the market goes from stage 1 to 2 to 3 to 4 and how it fits into the profile. So the psychology is really important because it's very similar to auction market theory. Stage 1 is consolidation. It's ambiguous. People don't really know, okay? The market is mostly unnoticed and underappreciated by the majority, by the public, let's say. But the smart money, who are they? They're the institutions, the hedge funds that got more than enough capital to move these markets. Even myself, I trade fairly decent size, but nowhere near as big as these guys. I can't move the market, right? Even with my 20, 30 contracts, I can't move the market. Right? On a small market, yeah, maybe for a couple of ticks here and there, but I'm talking about sustained moves. What are the big players thinking? The smart money. Now, smart money always typically begins to nibble up supply in a consolidation phase at some kind of low or some kind of support. From that, we typically get a breakout, which some people will get called out on and actually comes back down again. And that's why you typically see stage 1 and the stage 3 hold out for a little while. Now, what tends to happen is we get into a stage 2, an early stage 2, and people just keep buying. They just keep buying. And if it's a large enough time frame, it's usually the longer time frame buyers, which is the institutions, the hedge funds, they're coming into the market, buying these opportunities because they're typically longer term players. They're not scalpers, right? So they're going to start buying at higher price and the market just keeps going higher. All right? But there's a very specific point that it gets to when it gets too high or when it gets too low. Okay. So we do get into stage 2s and then we go into a late stage 2 when the market's overextended upside. I would say that's when the herd is finally buying, that typically realize, wait a minute, I was wrong about getting short. I might as well go with this market. It's not stopping, right? It's usually too near the top. Smart money takes the profits. They're getting out. Herd stampedes into the market in stage 3, while the smart money takes the profits. They're done with the trade. The market moves up and down in erratic price swings, resulting in rising uncertainty. And then all of a sudden, it doesn't always move down from here. I'll clear that up right now. Sometimes the market keeps moving higher. The question is, though, how do you figure that out? All right. So what I do is basically I recognize a big move up. I recognize a stage 3, and I recognize where it is within context. And I try to figure out whether a stage 4 makes sense. And if it does, what is it I specifically need to see? Okay. So there's a certain thing, like if I was to draw a value area and a balance area around that stage 3, I would be able to figure that out using the concepts that I want to share with you right now. Okay. The stage 4 comes in, which is basically the smart money liquidates a bit long positions, initiate shorts. The herd thinks the market is cheap. They keep buying because they think it keeps pulling back, lower prices. Let's keep buying. Typically, there's always someone getting sucked into the market on the wrong side. Like the smart money does business usually, typically in the right places at the right time. Now, it doesn't mean it's always going to happen. You know, there is going to be times where the unexpected happens, right? But it's not that frequently. That's why it's unexpected. The late stage 4 is when the herd finally gives up. They start selling. Smart money's already done. They're covering their short positions, buying into the herd setting, right? And that's where you get a bottom again. People thinking, oh, big downtrend. These markets have had it. You know, it's got to keep selling off. This is the big crash that we've been waiting for. It's probably happened loads of times this year and last year. And, you know, then we go into stage 1 again. It starts over again, but it doesn't happen exactly like that because the market's not sideways forever. But it's a very good foundational concept to get. You could look at any price chart on any market, on any time frame, and put it into a stage and understand it. So that's how I first started trading with context. Auction market theory added on top of that. And now, if you notice to the right, I have the basic foundational concepts of auction market theory, where you basically find value when the market is basically sideways. And it's basically just balancing, and price action typically moves sideways around it. So it typically does this kind of thing. But usually if it's a big enough time frame, you'll have some consolidation at the highs, some consolidation at the lows. And that's what makes buying below value and selling above value tricky, because sometimes it consolidates. It thinks about making the move up. It thinks about making the move down. And if you don't time that right, you could have the right idea, but you don't actually stay in the trade when it actually happens. The trick to actually finding the right time to get in comes down to confluence, using other markets to help you, short-term price action, and short-term profiling action. But it's much of an art form. It's not really what I'm going to go into now, but because I haven't got enough time, but it's what you have to look for. But the basics here are, if we define value, we basically have what we would call an unfair high. The whole point of a value at high, because some people get into profiling and they say, well, should I buy the breakout above value or sell the breakout below value, or should I fade it? I don't really know. Most people don't answer that question because they don't know. But I can tell you specifically, when we're at unfair highs above value, if you're going to trade auction market theory, specialize in trading value. Trade back to value. Okay, trade back to value and specialize in that, because you have to make a choice. Are you going to be the one that's going to trade away from value consistently or back to value? The high probability trade is back to value, because that's where the acceptance recently was. That's where it was proven. Now, the imbalanced trades and the moves away from value do set up, but there's a specific time and place that it happens. That's what I'm going to share with you. I'll show you some examples this week. So basically, once you define your value, and you do this manually, it's not the developing value area for the day. I'm going to show you how to define this manually. Once we get above that value area, it's unfair to buy. You can't think about buying. Once it gets below that value area low, you can't think about selling. It's disadvantageous for the auction market theory value seller. It's advantageous for the buyer. You got to think that way. You got to think this is advantageous for a buyer. It's not advantageous for a seller. It's disadvantageous. So I don't want to be a seller right there. But where do you say, okay, well, I'm not going to be a buyer anymore. I should actually think about selling. You also need to know that. So the basic concept that a lot of profile traders will tell you, auction market theory so-called specialists will tell you, look, buy below value, sell above value. But when do you say, look, that's enough, I'm going to have to shift my perception. I have to make a choice. I have to move away from trading away from value. The market doesn't want to stay there. Well, I can show you specifically what you need to have a look at, because it's really, really clear. The thing is, it's very consistent too. And that's where the Fibonacci extensions come into it. Now, the typical routine for me, this is what it is. I always have a top-down approach. Start on the daily chart for the markets that I'm interested in, and I look at what's going on, bigger picture there. I'm not necessarily looking at those trades to take, because I'm not a swing position trader. I have been, but I'm not anymore. I then move to a long enough time frame that's not too short term, that gives me enough of a range that I think, okay, this is worthwhile trading. If the range is too small, I won't trade it. If the value area is too small, I won't trade it, because the risk to reward is not good enough. I might drop my size, think about that, maybe going, I want at least 2 targets available, 2 scale outs. I have specific targets, specific scale out levels for every market that I trade and have traded, because I've learned that through experience. Not based upon back testing, not based upon regurgitated knowledge or stuff like that. It's basically based upon real experience, trading experience in the markets that I trade. And I'll be the first one to admit, I don't know about the other markets that I haven't traded and haven't spent any time on. I can't tell you that. I can only tell you about the markets I know, which is the Bund, Bobble, DAX, Euro stocks, ES, YM, NASDAQ, and crude oil. And gold a little bit, but not enough. Euro, maybe a little bit. I can provide guidelines with those, because a lot of my students have worked with those markets, but those are the main ones. Now, first thing, always start on the daily chart. Move to a 30, 60-minute chart, typically minimum. Sometimes I move to a 15-minute if we've got really small balance areas, but usually see that on a 30-minute chart. Ensure the range is wide enough to reach objectives. For example, the E-mini S&P, I'm not interested in anything that's less than 4 to 5 points. Typically, I will find opportunities 5 to 6 points and between 7 and 10 points. Now, on the Bund, which is my main market, I typically look for something between 20 to 30 ticks absolute minimum, but ideally 30 to 50 ticks potential, which I haven't seen for a while, but it actually started to set up this week, but hasn't made the move yet, but I'm still going for that one if it keeps setting up. So what we do once we establish the market sideways is basically finding balance, it's accepting. I draw a custom profile over the developing range, and basically price action has to do something really simple. So it has to move up, move down, retrace more than 80% up to at least 100 to 120%. So if you measure that's a low, that's 120% below, that's 100%, that's 80%. That's basically it. Or the other way around, it moves up, starts to retrace. Sorry, the other way around, let me do that again. It moves down and then up 80%, 100 or 120% roughly, just approximately, basically just to show you that it's come all the way back into that high or nearly, because it's basically taken out all of that. It's not interested in what it's done before. So that's a beginning of a sideways balanced market from price action. candlestick chart, bar chart, doesn't matter. That's when you can start drawing a profile and assuming that value is being found. Okay. Now, once you've got your value here, which is where 70% of the trade and the volume traded, I look at volume. Okay, 70% of the volume. You establish where most of the acceptance was, where the market itself wanted to trade. Then once you understand that, you know what the typical range is for the market. And if the market establishes a range of value that's wide enough, big enough to hit your objectives, for example, let's say your objective is at least 6-7 point move, not necessarily for all in, all out approach, because that's not going to work. You have to scale in and scale out. I haven't got time to get through that, but you have to basically think about, is it worthwhile me getting into this move based upon my risk? So you can choose your risk exposure. You don't really know where your stop should go, not effectively, until you actually get in. I speak a lot about that in real time in the room, because you have a rough idea of what kind of risk you can take, but I have a range. I know I can put a stop between 8 to 12 ticks on the burns. Typically in the training room on the ES, I talk also about 8 to 12 ticks, but you're not going to know until you know your entry point, because you can't possibly know. You can't keep it fixed because the markets are not fixed. They are dynamic. If you try to keep things too fixed, you're going to get eaten up, because the market loves people that use fixed parameters, because that's how it's going to shake you out. So you have to be dynamic. You have to be able to make choices, decisions on the fly with this stuff. And that's how you become effective. That's how you become the best. So once you choose your risk position size, you have an execution plan, you go into that process. You also draw your Fibonacci retracement extensions. I've just done that recently for the ES for both downside extensions, just in case we get the breakout up or the breakdown. What we don't do, however, with the altruistic trading framework is switch to buying breakouts upside or downside. There's a specific time where it's okay to do that. Doesn't happen that often, but the last 2 weeks we've had it almost every day, because the markets have been developing short-term balanced value, and it's been a bit more volatile. But that's just a phase. It's not going to happen like that forever. But the most important thing is it still fits into the framework, and the markets still respect that. So it's fantastic to see that. So use the framework for framing the market. That's why I call it a framework, not a system. It's called the altruistic trading framework, because I use this framework. I put it on any market in any given situation. I understand exactly where I am and what I should expect. No question of a doubt. I should be able to apply the framework if you understand the basics. Even what I share with you today, you should be able to go away, apply it to any market and say, look, this is where it fits into that framework. This is what I should be focusing on. No doubt about what you should be focusing on. Because if you have doubt, you're going to mess up the trades, because you're going to get out too early. The fear and the anxiety is going to take over. You don't know enough. You don't understand it well enough. The framework has to be very specific. You've got to apply it and say, look, that's the only thing I'm interested in. If it comes my way, I'm engaging. If not, I'm staying away. So I don't care about the big breakouts that don't set up, because it's none of my business. So use the framework to frame the market. Okay. Always focus on trading back towards value, as long as there is no clean break of the 161.8 Fibonacci extension. These are retracement extensions. If anybody understands Fibonacci, there are extensions, there are retracement extensions. And I'm going to show you quickly what that is. Only ever consider trades away from value between the 161.8, 261.8 extension of value. Let's observe some examples. I'm just going to quickly show you some diagrams before I look at the charts. But this is the basic balance phase that we see. 90% of the time, this is what I'm doing. I find balance value. I will only trade if I have balance and value that's been established. It's there most of the time. There's a time where we'll be in the phase of the breakout and there's nothing setting up. But typically, you've got to have balance value even into new highs, like we've seen on the ES for the last 2 years, the bund recently since the beginning of last year. You'll find balance. You'll find value, even if it's just for a day or two, even if it's just like recently for one session. In the next session, we're gone. We're breaking out. There's enough room to maneuver around that, enough potential for your objectives. You go for it, because the structure is there, still the framework. So you find value. Excuse my drawing here, because I've done this all by hand, which I'm sure you'll appreciate. So the blue triangle actually defines value. That's supposed to be distribution of volume at price. Of course, it doesn't look just like that, because that'd be great if it did, but it doesn't. Volume at price looks a bit different. But, you know, the idea is that most of the volume is the middle of the range. That's the VPOC, volume point of control, the red line. Value at high is where the typical indicator will put your value at high based upon the fact that 70% of the volume traded between this range between VAL, value at low, and VAH. Anything above the value at high is unfair for buying, so you don't buy there until you get to a specific point. Anything below the value at low is unfair for the sellers until you get to a specific point. That specific point is anywhere above the 1618 extension, Fibonacci extension, and anywhere below the 1618 Fibonacci extension downside. Now, quick quick crash course in the Fibonacci. It's invented, it came up by an Italian mathematician, right? I think his name is Leonardo Fibonacci or something. Excuse my lack of knowledge there, but I'm not interested in that. I'm interested in how to use the tool. I used to know that stuff. It's not important, right? So this guy, he come up with this idea that, you know, there's these ratios that show up in the universe and everything in life, like plants, in the human body, in the organs, the way we are made as human beings, the way the world is made, the earth is made. So these ratios, and the golden ratio was 0.618. And basically it shows up again and again and again throughout the universe and everything that sort of manifests itself. Now, that itself is all like hunky-dory, fairy tale stuff. It's, you know, okay, well, fair enough. How does that apply to the markets? Most people say, well, Fibonacci doesn't work. All makes great sense. It's all really nice and interesting and mystical. But, you know, the thing is, if you don't know how to use it, of course it's not going to work, just like moving averages and any market profile strategy. Now, I don't use the typical Fibonacci retracements, which are 38.2, 50%, 61.8. That's basic stuff. I'm not dealing with guys that are completely new to trading. Most people have been through Fibonacci. If you're not new to Fibonacci, you just do a bit of Google on it, check it out, right? 127.2, 1.618 extension. And I'll tell you where I picked that up from. A woman called Caroline Baroden. I don't know her personally, but I did see some of her presentations, and another guy called Mark Braun. And I watched his presentations and I learned the Fibonacci extensions. And I used to do a lot of clustering and putting clusters together, etc. I didn't need them after auction market theory and profiling, but I used to do a lot of clustering to find support and resistance. But I no longer do that. The thing that I found was most effective after using Fibonacci for about 4 years, I said, look, the most important thing is Fibonacci extensions. That's the one that stood the test of time. That's the one that it's proven to me that happens so often. And it actually fits into me trading value and into sideways ranges. So that's what I'm going to use, because I'm not a trend trader, not trend trader specifically. I will trade the short-term trend. I will use the short-term trend to back up my trade from a longer-term perspective. And I'll show you guys how to do that in real time in the room, which is really important when it comes to timing and execution. But basically, the market can move outside of value and below value. It doesn't mean it's becoming imbalanced. Now, auction market theory and typical market profile doesn't teach you that. They just say, look, it's market balances, it becomes imbalanced. And people start thinking, oh, as soon as it starts to break the high, as soon as it starts to break the lows of the range, it's breaking into imbalance. And that's where it's going to catch you out, because it's not. It's not imbalance until, because it's very natural for the market to test. If you think about this as people, it's very natural for it to test above the high and below the low, because that's where people's stops are going to be. Firstly, people that shorted up here at this high, people that bought at this low, their stops are, let's put it in a circle, their stops are up here or below here as sellers and buyers. It's not because it's a stop run. That's another misconception. It's because the market is an auction. If it gets all the way up there before and people keep buying through it, of course it's going to go above it. But it's a matter of whether people are interested enough to keep buying above that level. And the chances are, if value and acceptance is still below us, down here, the chances are those buyers are going to be going for breakouts. Now, if you're a scalper, you can probably go for those, meaning you're getting in and out within like a few minutes, like probably within about 5–10 minutes at most. I'm usually in trades about half an hour, minimum 20 minutes. I'm usually out really quickly within about 15–20 minutes because I'm wrong. But if I'm right, I'm usually in those trades for hours, like quite often 2 to 3 hours, sometimes even more. as long as the trade's not over, because I just sit on it. I just scale out, reduce my risk, and make the most of it. That's what I do. I look for the 1 to 2 main swings in the day. That's it. Sometimes none, but if I wait for them, they come my way. So what we've got here is like a potential breakout below value as well. We typically get to 127.2, 161.8 Fibonacci retracement. Yeah, that's the one. Merce, Fibonacci Queen, Caroline Broder. Fantastic stuff. I mean, I don't use the clustering, etc. It was a part of my journey, but I don't use the clustering specifically. I think the Fibonacci extensions for me work the best, and that's what I use. And clustering is fantastic. I think it's a great strategy. It's just not what I use because I find better levels from profiles. So now we do move to a phase where we say, look, and it's happened recently a lot more often than it usually does. And people are thrown by this. They're thinking, oh, market's balancing. And wait a minute, it keeps going, keeps breaking out. That's because the volatility is there and the ranges are not wide enough to hold the market for long enough in those ranges. So what we're finding is typically this situation is happening, and we've seen it recently a lot, where the market breaks the 161 extension. And I usually say, look, the market has to accept above it on the developing profile. So like this bulge of volume here, that's supposed to represent the developing profile acceptance, right? Intraday, in your profile on your chart, you should see some sign that volume is being accepted above that 161 extension. When it does, a low volume node is going to show up below it. This is for a breakout up. Okay, it's just the inverse, the opposite of this, like a mirror image for a downside break. And then the note here, always look for an LVN or low volume area, because sometimes it's wider than just one node or one price, quite a bit above the 161.8, okay, or below if you're going for a downside rotation, okay. So now that quite a bit, people get thrown off. Now look at the profile. The profile should define. Basically, it shouldn't be right on top of the 161 extension or just below, because if it's too close to 161 point extension, let's say like a more volatile market, at least a good 20 tick break above or below the 161 extension, for argument's sake. Typically, that's what you're going to find as a minimum. Like NASDAQ, YM, DAX, at least 20 tick break of that level. Okay. Most important thing, the profile is going to give you the true area. Liquid products like ES, Bund, Euro stocks, just a couple of points, like 2 points, 8 ticks, 10 ticks, maybe on the ES. Good clean break of that level, because what you don't want is to make the choice and the decision to start playing the breakout of the 161.8 extension specifically, because that could quite easily just test above it and get back below again. Okay, so it always needs to be a very clean break, and there has to be short-term information. We usually see short-term price action confirms it and the order flow. Now this trade, and it's quite funny because just last week we started the year for the room again, and I said this doesn't happen that often, and it happened on like I think it was Monday, and it happened the next day. I said this doesn't happen that often. You know, we probably won't see one of these again for another month or two. That's normally what I expect, and this is the nature of the market. What did we get? We pretty much got the same trade again every day since. Even again, I think we even got it today. And the thing is, because the markets don't stay the same, they keep changing. But the thing is, this framework allows for us to measure that move because it's looking at value, it's looking at how far we can go. And it still applies. And even to the fascination of myself, I'm seeing it playing out pretty much every day. And I don't expect this move that much. And even myself, I do trade it smaller. I drop my position size because I don't see it a lot. But recently, the market conditions have played it off consistently, time and time again. And, you know, we've had to adapt to that sometimes. Now, if you don't have that in your framework for profile trading, you're not going to understand that. People are going to be thinking, oh, most people I know, auction market theory profile traders, they trade value and that's all they understand. But they have no concept or understanding of when to stop selling above value or stop buying below value. Because typical auction market theory, traditional market profile theory, auction market theory, at least what I've watched, understood, read, doesn't teach you that. Doesn't teach you it. All right. So that's why I call this a unique L20 trading framework. Because as far as I'm concerned, this is my work. This is what I've created, and I'm sharing it with you because, as I said, I made it leave a legacy. I don't want to keep this stuff to myself. That was a promise I made to myself when I started this. I'm not going to be like Lord of the Rings and just protect the ring. I'm going to give it to people because that's the way I'm going to leave a legacy, because people will share it and they'll teach someone else. They'll share it with someone else. That's what I want, you know? So I don't give a shit about, you know, it's not going to stop working because I share it. That's a load of bollocks, right? People say stuff like that. It's not going to stop working because I share it with others. I mean, the most people on probably reaches a few thousand. That's not going to change the markets. We're never going to take out the big players, the institutions, the hedge funds. We're not going to move the markets. The fact is, though, at least we can play alongside them, right? And that's what we can help people do. Not just me, but you guys as well. So let's keep moving forward. Now, I'm going to move to some charts because I haven't got long. It's about an hour gone over. But let's look at the current market situation. I'll talk about what's already happened recently. Let's just look at the ES. Okay. Now, I do use confluence, meaning I will look for the same situation, same scenario, not only on the ES, but also on the YM and the NASDAQ. When I'm trading the Bund, I look for it on the bubble. When I'm trading the Euro stocks, I also look for the same kind of situation on the DAX. The reason being is because the confluence helps me firstly trade less, but also it helps me become more disciplined, because if you don't provide yourself an opportunity every 5-10 minutes, you're not going to take a trade every 5-10 minutes. Now, if your business plan says, look, trade every low volume area, trade every little imbalance upside downside, always buy order flow when it's lifting offers and sell when it's hitting the bids, you're going to overtrade and you don't have a structured approach. Your plan is flawed. It's not good enough, right? Whereas what I defined here as the ultra trading framework is very specific, very structured, and therefore it's easier to follow. And if something is easy to follow, you should be able to develop more discipline. But not only discipline, the difference between what the ultra trading framework is and a system, the system can be back tested, right? But you're always relying on the fact the market's going to do what it's done before. What I do is I rely on experience, but I also, at the same time, always understand what's going on right now through market-generated information. And that's the big difference. So my edge is through understanding what's happening right now and making choices and decisions based on what the market is doing right now. It's not relying on back tests. I have belief and confidence from past experience, yes. And I can't pass that on, unfortunately, but because I can't just box it up and give it to you. But what I can do is say, look, these concepts work. You got to trust me. You got to try them out and do it yourself. If it doesn't work for you and it doesn't make any sense, don't use it. Move on to something else. But find something that, for God's sake, at least find something that you believe in. Don't trade something that you don't believe in, have confidence in. It doesn't take a rocket scientist to figure out if someone's talking bollocks, right? It doesn't. So, you can do that just by listening to someone. You can tell day in, day out. You just listen to someone in a room. You can tell whether they don't know what they're talking about. You can tell, right? Come in our room. If you think I don't know what I'm talking about, you don't believe it, fair enough. Move on. You don't need to get in touch with me. I don't need to know you. But at the same time, I know, and I have enough confidence in what I know and my experience that I know it makes sense. Because if it doesn't, you tell me, because I want you to challenge me. I want you to show me. I want you to prove it to me. Because if you do, I will eat my own hat. I would, because I need that, because nobody else is going to teach me that. Nobody else is going to show me. I need people to show me, look, this ain't true. This ain't working. But until you do that, you just got to shut up and listen, right? You got to just listen and move on and take it on board. Okay. So, because you can't do anything else. You got to trust someone. You got to have respect for someone. You got to say, look, this guy knows. He knows what he's talking about. This guy's talking bollocks. I'm going to listen to this guy, right? You make that choice. You make that decision. I'm not going to do that for you. I can't do it for you. But look at the market right now, okay? I've already taken these levels. Most of you guys know in the room today. I've got balance and value. It's skewed a little bit. I had it here yesterday. Well, firstly, look at that range. Let's take Fibonacci extensions off the charts. I've already defined balance value is, right? The way that I do that, I use market delta charts. You can do this in NinjaTrader. You can do this in Fibonacci Trader, not Fibonacci Trader, NinjaTrader, Sierra charts. Now, what you'll notice is I have custom profiles. I don't use traditional profiles. You don't need TPOs. Okay, you don't need them. You need volume at price, and that's it. You need understanding of price action structure and volume at price. That's it. At least the way that I do it. Okay. Now, this is clearly a sideways phase, and initially we'd look for resistance above value. Now, I've taken these profiles manually, and I'll just draw this one back in to show you how. I've got webinars on this stuff already, guys, on the website. Go to l20.co.uk. I'll just send the link right now. There's a webinar archive. It tells you how to do custom profiling, composite profiling, all of that stuff on the webinar archive. All free stuff. You don't have to pay for it. All right, so this is the website, l20.co.uk. If you go to here, the l20 webinar archive, there's a load of free webinars. And if you listen to volume profiles in market data to help form trading ideas, art of profiling, watch them all, okay? Go through them, and they will teach you how to do custom profiling in more detail. Because admittingly, I'm just going to rush through it right now because I haven't got the time, right? I'm going to get into some other stuff instead. So what we've got here is basically a custom profile, and I use the profile drawing tool in Market Delta. I put it in, I draw it from left to right, from the range where it's developing. Now, admittingly, again, you have to do this in real time as we're developing around that range. But let's have a look and pretend we don't know what happened after that range. Firstly, I could have taken a Fibonacci extension. You have to configure these retracement extensions, right? You have to configure them. They're not going to be automatically set up for you. You have to do it in Market Delta, any software. So I'll show you how it's done in Market Delta. So I take this high, that's the high there, to the low. So the trigger is high to low for extensions upside, okay? I've already got one there from before, which I'm going to delete. What you notice here, firstly, I've just taken a swing high to low. That's what you've got to do for extensions upside, right? How far can the market go and you can still look at shorts? Well, firstly, it's basically 1272, 1618 extension. All right. Now, I've drawn that profile tool in. If I show you how it's set up, mine's always pre-configured and I've saved it as a default. 127.2, 161.8. Admittingly, I use the fixed values because these are what have been taught to me and I respect them. But the thing is, you see Market Delta puts 0.7999. I changed that to 8. It displays it as 8, but you know, for whatever reason, it changed it to 7999 all the time on this screen. But that doesn't matter. It actually is 261.8. Now, it doesn't really matter if you get rid of the points, to be honest with you, because Fibonacci is not that accurate. You know, so you don't have to use 127.2, 161.8, 261.8. I purely do out of respect for Fibonacci, but also because I'm used to it. It's a habit. So yes, you could get rid of the points because it's not going to really move it. Like I get rid of them, it's not going to move it. It's going to be in the same place roughly. And that's all I need to know. So now what I know is like that blue box area, that's everything above value basically, right? I know when the market's there, I know I will look for shorts, but I'm not going to pick tops, right? That's very important. I'm not going to start looking at order flow and short-term price action soon as we get to those levels. One thing you have to understand is when these extensions occur to the 127.2, 161 point extension, we typically need a topping formation because the ranges that I look at are usually pretty wide. Now, at a small range, if it's like an extension out of a range that we've been in for the last hour, 20 minutes or so, then you don't need a topping bottoming formation. But I do need a topping bottoming formation in most cases with these, and you have to wait for them. So don't start shifting the order flow right at these levels. It's not going to get you very far. So you're going to be very careful you're not picking tops and bottoms with this strategy. Okay. Now, what I am going to tell you though, once it keeps breaking through the 161 extension and it doesn't top out, you've got to be prepared to identify. In this case, it would probably have to be, and I did this the other day, just that LVN just above it, 39s. I've already got the vision from yesterday because I did this in the room, and we then looked for the move into 2052 above. Okay, I'll show you the screenshot because I did this yesterday. Before the market made that move, I knew what it needed to fail below. I prepared. You see the blue box? The blue box highlights that's no trade zone. I don't know what the hell is going to go on here. Like I couldn't tell you if it's going to go up or down. I don't know if it's going to go back to value or it's going to go further. But I do know I'm interested in buying if it keeps breaking past 2039. And then I expect it to go 2044. I mean, that's what that arrow represents. You notice the YM on the right and the ES on the left. That's confluence because I'm looking at two markets that are related, making the same move at the same time, right? Now, we ended up going to 2048.50. Normally where the move stops is around the 261.8 extension. You'll see that a lot. And it's what you look at on the ES is you'll notice we got to that area, then we stalled, then we come all the way back down again. In the end, we actually set up this move, 1618 extension, moving back below, because that sometimes happens. We get further up and come back down again. And then we go back to the prior value area. Now, we actually have a value area here on the left as well. All right. I'm speeding things up a bit because of the time. But, you know, the thing is, this is here to, you know, the point here is this is going to provide an intro. You're not going to learn how to trade in an hour. You know, let's be honest, right? You're not going to learn how to trade in an hour. You're here to learn some concepts. And I think I want to provide value, because that's all I'm ever going to do. I'm not going to sit here and just talk shit for an hour, right? If I provide value, you would know it makes sense. I like that. I want to learn more. And then, of course, you're going to come and get into my room, or you're going to, you know, get some coaching or training or something, right? So that's why I do this, right? You know, let's not beat about the bush. So, you know, but at the same time, if I don't ever hear from you, I don't want you to go away thinking, oh, well, that was a waste of an hour of me, you know, and my time. I want you to at least respect what's been shared, you know. So I'm taking a bit of time with stuff rather than just rushing through it. But, you know, you see these divisions, I clearly draw them up. What you notice is the green circle here represents where I'm interested in buying, the red circle where I'm interested in selling. What you notice is that I'm not buying and selling within a certain zone. That blue box identifies, I don't know whether to buy or sell. I don't know whether it's going to try to go down or up. I don't know. So I'm going to stay the hell out of that, right? And you do that because you need to do that rather than sit there and and ah, say, oh, I should be long, I should be short. I don't really know. Get short. Oh, no, wait a minute. I'm wrong. Let's get long. Don't do that. You should never sit there and reverse trade. You don't know what you're doing if you're doing that. Okay, so what you notice here is the ES, what does it go? It goes exactly to that 2618 extension. Bang on. It makes the extension from here to here. Bang on. I mean, I know this for years and years and years. All right. It happens, right? If you look at the extension towards the downside of that range, now we did find new balance and value, but let's take the extension anyway. Where did we end up putting the bottom in the next balance value area? Where do we put it in? Take the low to the high of the range. What do we know? 261 extension. Yeah, we tested a little bit below it. But as far as I'm concerned, that's a 2618 extension. There you are, 90.92 half. It's not exact level. It's a rough area. But at least you know, once we got into this area below that value area, you know, if you happen to be trading overnight, which is when it happened, you know you got to start. I mean, actually, a long would have played off there into the close yesterday. But once it starts breaking that area clearly, gets below this LV, and that would be the 2000. You've got about 7 points to play into 93. You already know where it's potentially going to. You know, which is, you have to know where it's potentially going to. How else do you know what the potential reward is? You can't decide on risk if you don't know where the market's potentially going to with some belief and confidence, right? That's why people get out of trades quickly. They get out of trades prematurely because they don't really understand what they're doing. You know, let's not beat about the bush. You don't if you're doing that. You know, of course, sometimes you do things you know you shouldn't be doing. Now, look, I've got current balance and value. The market's pretty sideways here on the ES, okay? Very symmetrical. We've held the unfair highs here today. I've already covered that. Actually, I did cover the move up today in the room, if I remember correctly, because I covered a couple of longs. First one worked out for first, second target. Next one fouled, and then we set up again for all 4 or 5 targets. It depends on what targets you went for, okay? Now, since then, we've started to foul and then come back lower. But did we take out a 161.8 extension of that value area? Did we? Swing low to high, extensions downside. Swing high to low for extensions upside. Configured, again, in this way, 127.2, 161.8. Forget about 38.2, 50%, 61.8. Those are typical Fibonacci ratios. You don't need those, all right, unless you're a trend trader, which they can be useful with. I'm not a trend trader. I trade value. So 1272, 1618 extensions are more valid for value. All right, now notice, what has this market done? It extends to below value from this low to this high, 161.8 extension. What do we know? Comes back into value. Now, I'm going to tell you, right, don't trade these levels as soon as we get there. You wait. You can afford to wait for some kind of bottoming topping formation. It usually takes a good 10, 15, 20 minutes before it even thinks about moving off that move. Because I'm usually using a longer time frame. This is a 30-minute chart. I don't go any lower than that, sometimes 15-minute. That's the lowest. I'm usually looking at 30-minute, 60-minute, or 120-minute chart, okay? So these moves are not going to happen like within minutes or seconds. So that firstly provides you the opportunity to understand that and know, wait a minute, I don't have to rush into these trades because I know it's going to take some time. Okay, so I've gone in some examples of the basis of the Ultra trading framework. Find value. Personally, look at price action and say, is it going sideways? Okay, well, let's see if there's value being distributed around that. Draw the custom profile around it. Custom profiles in most software, you can draw one. You basically need to use it as a drawing tool, but draw it from what looks like it's the beginning of the range. You need to start drawing the profile as soon as you see a low to high that is about anywhere between 80 to 100% retracement. So that swing up, if you look at this is probably about 80 there, and this is about 120. Give or take a little bit, right? Now then we had about 100% retracement back up here. That's balanced. That's sideways. Look at price action, then draw your profile around it. Okay. Now there are more concepts which I haven't got enough time for, but I've already gone, 25 minutes over the planned time to present, and now I'll take some questions and I'll provide some answers. So I'll give it about 2 or 3 minutes. Let's say 3 minutes. Ask your questions, and then I'll be happy to answer. And I'd be happy to do that for about 15 minutes. Of course, you need to know a lot more. I'm not going to beat about a bush and say, look, this is it. This is where it starts. But at least it's structured, and you got to then move on to how do I actually time that trade? What do I need to see specifically? How do I use confluence? What do I look for on order flow if you use it? There's ways to trade without order flow. Order flow is not necessary unless for the liquid products. I think it's much more useful there. Volatile products, you don't even need it. Okay, so I'm going to take a little break for 3 minutes, and then I'll wait for some questions and I'll take them and answer them. All right, guys. So doesn't look like I've got that many questions in the chat panel. So I've got one from Hal. So Hal, firstly, a question on the fib. The one you drew from the balance area just now, what if the price after a small pullback continues to go down? How do you ascertain the targets then? Well, the targets are a combination of market profile, volume profile levels, but also at the same time, I have something called harmonic targets, which I'm going to bring up, which I normally share with room members. So with every market, while structure makes a lot of sense, right? You can't forget that every market has a natural rhythm. Whilst it changes slightly, we typically revert back to what it was. Okay. So every market has a natural rhythm. Now, this is the thing that I share with room members a lot of the time and people that I train and coach. So what you notice is I've got 4 to 5 targets. So if someone trading, let's say, for argument's sake, let's just say 4 to 5 contracts. Okay. Now you could use 20 contracts and go for 4 targets. You could go for 5 targets with, 20 contracts or 10 contracts. But what I'm going to say is, look, let's just say 4 to 5 contracts, which basically means 4 to 5 targets. 2 targets, let's say that's 2 contract person. Now, somebody that's trading 2 contracts doesn't really have a choice. They have to use 2 targets. Now, somebody that's trading 1 contract, and I'll say this right now, if you've been trading 1 contract for a few months or even years, don't expect huge profits because it's very difficult to make money trading all in, all out with a 1 lot. There's certain markets you can do better on, like crude oil, YM, NASDAQ. A lot of people I've seen that I've worked with traded the ES, and they've been there trading a 1 lot, waiting for themselves to become hugely profitable before they put the 2nd lot on, the 3rd lot. You're not going to get there with a 1 lot. At best, you're going to be just above break even. So because the risk to reward is too low, and your consistency of getting bigger moves with a 1 lot is it's very difficult. I'm not saying it's impossible. I have seen one person that I've coached out of all the students that I've coached one-to-one actually being able to achieve big moves on 1 contract. Now his win percentage was low, probably between 40 to 50% most of the time. But when he did get the bigger moves, they were much bigger. So the thing is, that was a NASDAQ. And the thing is, most people can't do that because the win percentage is too low. They lose confidence because, you know, the fact is human beings don't like losing. But in trading, you have to be okay with it. Doesn't mean, you know, you have to lose a lot, but you have to be okay with those few losses, you know, and you can't be 100% perfect. Like I was down yesterday. It doesn't mean, you know, I've done anything wrong. It just is what happens. So the thing is, most people can't. I'm not saying it's impossible, but most people can't trade a one lot and go for big moves. Okay, so with 3 targets, a little bit different. I normally say, like, start with 1 contract as a drill, get consistency, try to hit your first target somewhere between 60 to 70% of the time, at least more than 50% of the time. You have to make, you have to develop the ability to be able to hit your smaller targets at least more than half of the time, because if you can't, it's pointless having a second, third, and fourth target. So, you know, I'll normally say try to get towards 70% win percentage on the first target, but keep it pretty close. That can help you with your timing and your execution, getting used to the rhythm of that market. But you have to move to 2 targets and 2 contracts very quickly, usually within about 2 months of some consistent results. Because if you keep trading a one lot, you normally will go to around $1,000, maybe just a little bit above, even if you're trading a one lot, usually just a few $100s up. Some of you guys have probably seen that. It's exactly what I do. I know, because I've worked with so many people. I've been there, done that. You basically will get about $1,000. Well done. My hat goes off if you get above that on one lot. But if you do, you're probably going to be pretty soon back to break even and just below break even. And then you just repeat that pattern time and time again until you start putting that second, third, fourth target on, because it's very, very difficult. I'm not saying it's impossible, because I have seen people do it. It even surprised me, but most people can't do it. Okay. So with 3 targets, like every market is a little bit different. These are basically my specific targets for the markets that I understand, know, and have traded and understand well enough to actually feel confident sharing it. I don't share things about markets that I don't know, because it's not ethical. It's not right for me to pretend I know when I don't know. Some other people would do that, and that's why I don't do that. I've always promised myself that I'm going to teach and coach in a ethical way, and I'm only going to share stuff that I actually believe I actually know and understand. So if I don't know and understand something, I'm not going to teach it. I'm not going to tell you about it, right? But that's why I say, like, Bund, ES, like recently I spoke a lot about NASDAQ, and I've said I haven't traded it a lot, so I will admittingly say I don't know it that well, same as CL, but I have traded them enough and watched them enough to say, look, I've at least got some confidence to share this with you. But I often say, like, I had a mentorship student switch from the ES to the NQ the other day, and I said, look, admittingly, I don't know enough about this market. This is what I would say, start with, but be willing to shift your targets and use your own experiences, because you're going to gain more experience than I know. So you always have to let your experiences teach you, right? Now, so these are targets like based upon ticks, but then you use a combination of just before low volume areas, before rejection areas as targets, and high volume nodes. So let's say, for example, you're long on the ES here. Actually, let's use the example earlier today, because I covered that in the room. So there was a long here, did come back again, but I spoke about targets, typically like +5, +10 tick target, first, second target, like covering ahead of this 2000 LVN, having a third target just above that, fourth target I was talking about in this high volume area, because there's quite a bit of acceptance there. And then I was talking about having, sorry, beg my pardon, because I was talking about fourth target actually just ahead of this LVN and a fifth target just above that, which actually I think we didn't hit, because I spoke about 2007 halves on a fifth target. Now, you can only go for fifth target if you have more than 5 contracts. Now, somebody that's only got 2 contracts or 3 contracts obviously are not still in that trade. They're done. They're out. If you're holding 2 contracts, you're not going to be holding for a move from 98s to 07s here. You know, you're pretty much going to be out with the harmonics in mind, and you should be out by around 16 ticks, because the thing is, it's about consistency. And with 2 contracts, most of the time, with the kind of risk you're taking, you're not going to get that enough with 2 contracts. So what's going to happen is over time, if you're not getting it enough with 2 contracts, you're going to lose confidence. You're going to start doubting the opportunities. But the thing is, it's much easier when you go to 3 or 4 contracts, because you basically get to a no risk situation really quickly. And I show people this in the room. You know, you take your 8 to 10 ticks, and by the time you get about 10 to 12 ticks favorable excursion, like E-mini S&P, then your stop goes to entry price, and then you have no risk on the trade. So it makes it a lot easier to hold on to risk and a position with targets a lot further away. And also at the same time, you've got no risk on that. So you're not taking any risk on the 3rd, 4th, and 5th target typically. So when you get there, apart from when you get a full stop out, and that's going to happen, you're going to take that risk on it, and that's going to happen. But that's why it's very important to have something that's high probability, because you don't want to get that often. So, I mean, the L20 trading framework, if you trade it well with the timing concepts, you shouldn't have a very low win percentage unless there are discipline issues, etc. So there are many other factors at play here. So Fibonacci extensions here. Again, what if the price after a small pullback continues to go down? How do you ascertain the targets then? So let's have a look at that balance area. So the balance area here, now we didn't go a lot below that. And that's why in the presentation, I said you need to make sure if you're going to go for, you're going to stop buying or you're going to stop selling. If it goes just below it, like it did a little bit, you always have to wait for it to come back above. You have to. Now, I fine-tune this with the low volume areas on the composite profile, which is actually where I do my main support resistance analysis. I'm assuming most of you know about how to do that, because if you don't, just watch the webinars, you know, on that link that I sent you guys, because I haven't got time to go through that in detail, but it's really, really important. So, you know, don't use Fibonacci extension without the low volume areas and a composite profile. You know, you can get that from the free webinars on the website. So, you know, I haven't got time to go through that. But the main idea is to have some rejection areas behind that. Now, you need also a bottoming formation. What you don't want is shorter term, the market's still making lower lows, lower highs, which are actually pretty much worse, you know, all the way down here. So I have more than enough time to wait for head and shoulders formations, little pullbacks, because I'm not trading in a way that I'm picking tops and bottoms, and I don't need to, because I'm looking at potentially bigger moves from a longer time frame perspective. So I can wait for the ES to move 7 or 8 points and still go for a potential 10-point, 20-point move with confidence. You know, I can wait for the bund to make a 10-tick rotation and still get into it. It's not late. And actually, it's much better to be late than too early, because this idea of being late is a misconception, because people start using lagging indicators and they hear things like, don't use lagging indicators, you're always going to be late, you're always going to be the last one in, etc. Now, it's not a race, right? There's no special recognition for being first. The market's not going to give you a gold medal because you were the first one in. It doesn't give a shit when you're in, right? The most important thing is you get in the right place at the right time. It doesn't matter. Sometimes it's got to be earlier. Sometimes it's got to be later. Now, I teach timing and execution. That's the most important thing that I teach. It's probably the best thing that I teach in the room. But you have to see it real time, and you also have to see lots of examples, because every trade is different, you know. And not many people are going to tell you that, because it's not attractive. You know, telling you the truth is not attractive. Telling you that you can't do this every single time is not attractive to people, because it doesn't sell. But I'm just going to tell you the way it is. I'm going to tell you things you don't want to hear, because you know, that's the way that I do things, and it makes sense. So Robert, what is the ideal size for a stop loss, Ricky, on ES? Typically, it depends on the style of trading. If you're scalping, you can use about a 4, even 3-tick stop, 5-tick stop, because you're using very short-term information. Now, I don't specialize in scalping, but I can teach it, and sometimes I cover it live in the room. I have done it. I've been pretty good at it, and I consider myself at least half decent scalper, but I'm not going to lie and say I'm an excellent scalper, because I'm not. I couldn't scalp, especially in the market conditions over the last 4 or 5 years. I couldn't scalp, and if I could and make consistent profits and better profits than I do right now, I would probably do that. But I prefer more of a laid back approach. And with a laid back approach, when you're looking like 2 or 3 trades maybe in a morning session, you're typically using wider stops. You can't execute like a scalper. You can't use their risk, okay? Because their risk and their way of getting into the market is only good for a few ticks. When you're looking for moves that are potentially bigger moves, you can't use the same concepts. Okay, so the stop typically on the ES is about 8 to 12 ticks depending on volatility, but then I have to see the trade set up in real time to say, look, that's the exact stop. That's where it should be. Because like earlier today, there was one trade I said about an 8 tick stop. Next trade I said about 10 tick stop. Next trade I said, actually the first trade was about 10 tick stop. Next trade about 9 tick stop. And the next trade I said it was okay with about an 8 tick stop. But I had to define that in real time because it was defined by the entry price and where the market gave the opportunity to actually execute. So I always have a range of prices where my stop might go, but it has to have a limit. Like, you know, it can't be just like indefinite. There has to be a limit on where your stop can go. Okay, so Robert, where are you drawing your original fibs from HVN to LVN on the custom profile you are creating? Oh, no. Okay, so Fibonacci is taken from price. Okay, so what you have to do basically is establish a major low too high. That's the one that I see there, for extensions below that low. And that gives you these extensions. Now, if I was to take extensions for the upside, I have to take a high to low. I'd like to clear out these are Fibonacci retracement extensions, not extensions. Fibonacci extensions themselves are actually a 3-point drawing tool. So you have to actually take 3 points. So it's not an extension tool itself. This is actually a retracement extension. The same tool that most people use to draw 50%, 61.8, 38.2 extensions, right? So now I still use some of the composite profiling stuff and previous value like up here. So if we make this extension upside, for example, I won't actually even think about buying, even if this market just keeps buying all the way up to there, because I will be looking at that buying and saying, that's none of my business. These buyers are buying into unfair prices. It's okay. They can profit from that. We don't need to specialize in that. It's not what I specialize in. I specialize in shorting against that, but at the right place, at the right time. If I watch them and observe them, and I can see when it's struggling in their direction, I can only do that if I'm not in the trade. If I'm long, I can't see that. But if I watch it, I observe it, I can wait for the auction failure upside. I can start seeing the levels up there holding, and then I can start waiting for the rotation down, because I'm potentially looking at a pretty big move back down from that point. So I don't care if it's moved 10 points off the high, you know, on the ES there. If it gets below, for example, gets to that level, let's say this is what the market does. It just blasts through those resistance levels, gets all the way up here. I'm still not going to be interested in buying. But if it gets to below, goes there, fouls, and then starts topping out, then I want to take advantage of all the guys that have got stuck long there. Now, what if it keeps buying? Where do I buy? Well, I would buy a good few ticks. That level there, 2042, is too close. But if I put a level, and I will see this all well beforehand, if it gets above 2044 quarter, sorry, 75, I can say if it gets above there, order flow is good. YM NASDAQ looks good upside, then I can trade this upside. Not only can I trade it upside, I know that with a high probability that it's going to 2074. Now, some people are sitting here saying, how can you know that? Or thinking, sorry. I'm telling you, it happens so often that you can't deny it. Okay, so try it out for yourself. Okay, if you don't find it for yourself, obviously don't use it, but you'll see it. You know, we've seen it recently. I've just shown you some examples recently because it makes sense just to cover what's happening right now. I could keep going back, like, you know, day after day, week after week, month after month, but we'd be here all day. You know, I know going all the way back to 2001, I've seen Fibonacci extensions 1272, 1618, 2618 doing this. Now, that's not a back test. That's true experience, real life experience. You can't read about that stuff, right? So, but at the same time, it's my experience. You guys don't have that experience, so you have to rely on someone like me to tell you. And how do you know I'm telling the truth? You don't know. That's why you have to figure that out. You have to sit here and listen, say, look, does this guy sound like he knows what he's talking about? Does this make sense? Should I follow it? Well, give it a shot, try it out. If it doesn't work for you, don't use it. That's it, simple as that, right? So there are more concepts that you've got to understand though, right? So let's have a look at the other questions. I haven't got a lot of time. I know I've gone over here. The market dollar profile indicator and overlay to your charting package, or is it? And if so, what platform are you using? This is market delta, and the profile indicator is included in the software. Now you can use Investor RT, which is basically what market delta is, but without the footprint. Investor RT is market delta without footprints. Market delta actually use a white labeled version of Investor RT and then added the footprint in. Now, some of my students use NinjaTrader or Sierra charts, and they've been able to replicate what I do in market delta because it's a bit cheaper for some. It's a bit more affordable. So some people just want to cut their costs, and that's fine. You know, you cut your costs, you cut your expenses, which is a good thing. Every business should do that. So there are other pieces of software that you can do this stuff in. The only thing is I can only really support you with market delta because I actually don't know how to use Sierra charts or NinjaTrader or anything else like that. So, you know, that's stuff you have to. But we've got a members website, and I can put people in touch with other members that are using Sierra charts, NinjaTrader, and you know, a lot of people have got themselves set up that way. So thank you for a lovely presentation. What is the best way to deal with stops on the ES? I think I've just covered that, but you do need to see real life examples because when the market is more volatile, you have to typically drop your risk in position size, but use wider stops. When it starts slowing down, you basically can increase your risk, but tighten your stops. The markets are dynamic, you know, so you can't use fixed stops and targets forever. It's a good place to start. I started that way, but what you will realize is that you can be much more effective if you use the market structure and what's actually happening right now. So if my entry is a little bit higher, I might say, okay, I might use a wider sell stop. But if my entry is a little bit lower, I might say closer to my level, I might say, well, I might as well use a tighter stop. But basically, I have a risk management model set up for every different position size that I can have for every market that I trade. And I'll just give you an example. This is what I've been using since 1st of September on the Bund, right? So I typically start with 20 contracts. I never go all in because it's a psychological thing for me. But also when you're trading pretty heavy size, I'm typically trading slower markets. Like when I trade the DAX, I trade like 4 to 6 contracts. But when I trade the Bund, I typically start with 20. If I'm really confident, I might go straight in with 30. But usually I want to try to scale up to 40. And most of the time I can't do that because the opportunity either plays off too quickly or I don't get a chance to do that. So I always am the first one to admit that I have been working on scaling in and trying to get heavier on positions since August 2011, right? All of us start trading and we just think, oh, well, if I can do this 1 lot, I do it 2 lots, 3 lots. I do exactly the same thing with 100 lots. The reality is you have psychological risk and then you have financial risk. You might have enough capital to take 100 contracts into a trade, but you might not have enough psychological risk to be able to accept that and actually handle that. So these are obstacles we face as traders. And you know what I realized? I've always been trying to push myself to bigger size. And even last year, I said I'm going to start trading more so 50, 60 lots. I did it a couple of times. And what I realized is that I don't care about increasing size anymore. I can trade the same size forever and I'll be happy. So I've got to a point where I just said, look, that's it. I'm pretty happy doing this for the rest of my life. I don't have to keep increasing size. But what I have is ideal average risk. This is what I typically risk with normal volatility, normal rhythm, nature for the bund on these position sizes. If I get heavier, you'll notice my risk gets tighter. 7 to 8 ticks, right? 8 to 12 with 20, 8 to 10 with 30, 8 to 10 with 40. Maximum risk in ticks is just in case the volatility kicks in, markets go quicker, and basically I need to take a little bit more risk because I need to give it more room to maneuver. Now, what you have to remember is when the markets become more volatile, you typically also have to push for more further targets. So that's why I have a range for targets on that harmonic targets range spreadsheet that I shared with you. So I then break this down to euros for ideal risk, what I typically will risk, and also maximum risk. So I know my maximum risk for each position size. But when I start the day, I don't know what position size I'm going to have. I don't know what stop I'm going to have. Now, I used to print this out and just keep it on my desk. I always have a risk limit on the day, though. That's set with my prop firm that I clear through. Basically, I use them as a broker. But I also have ideal risk. So like if I start getting anywhere close to like 5,000 euros down for the day, I'm stopping. Now, my objective is 6,500, 7,500. I don't hit that every day. There are periods where I hit it much more often. But last year and going into this year, I've not hit it nowhere near as often I did in 2013 and 2012. But my consistency is still there and my expectancy is still there. What you also have to remember is trading is not linear, meaning that it doesn't always go up and up and up. There are times where you're going to go up, pull back. You have to take 2 steps forward, 3 steps back, 2 steps forward, 1 step back. And sometimes you've got to take 3 steps back. But that's in terms of revenue, etc., profits. But don't judge your experience on that. Don't judge yourself just on that, because performance is much more than that. It's also about how about you as a person. Do you feel that you have improved as a trader? Do you feel that you are more confident? Do you feel that you are improving as a person, as a human being? Because if you are, you're still increasing your performance. You're still getting better. So performance is not the only thing you want to track, because sometimes you can get better as a person, better at understanding the markets and as a trader, but your results don't reflect that. But sometimes that's down to the market conditions, right? So, right, guys, I've gone quite a bit over. I think we've run out of questions. So I hope you guys enjoyed what I had to share.